All right. We're having some technical difficulties this morning, and hopefully this won't happen again, but you know how things go. When we practice and we still get technical difficulties, it is not fun. So we are running short on time. We already were going to have a cramped morning this morning. We have a hard break at 9:45 in the a.m. And before we start, the first thing I have to read, which may have already showed up on your screen, is our disclosure that the attorneys require us to read. So it just says, real estate investment results, if officers or members provide no legal or professional advice, you should always consult a licensed professional or a professional appraiser, real estate agent, financial advisor when making any decisions regarding the purchase and sale of real estate. The information obtained from reir.co, real estate investment results, or its members is intended solely for general guidance and exchanging, buying, or investing real estate, and does not constitute legal, financial, tax, appraisal, accounting, or other professional advice. Because real estate contracts, closing procedures, and disclosures are guided by state law, always consult a local professional when engaging in real estate transactions. So good morning and welcome to Investment Hacking Live. We are going to go over a topic called staring at the market today. This topic is one that I discovered when I first started. I was born into the real estate business in 2008, which was at the height of the crash nationally. In my local market, it was a little early, it was really the beginning of the crash. I want to go over one of the things that I discovered that was really helpful called staring at the market. And before I do that, I want to talk about a couple of different things. We will be having another meeting like this on Thursday at 9 a.m. I do have a hard break at 8:45 today. So if you have any questions, leave them in the chat. If we can get to those questions, we will. Otherwise, we'll have more time on Thursday to go through questions. You can sign up for, there'll be a PDF, so you don't need to take notes today. We may have, the microphone may not be as good today because we couldn't get some of the technical stuff. So if you can't hear some things, you can also put that in the chat. And then sign up for the PDF because you don't have to take notes. We will have a PDF to deliver to you. And we also can give you a replay if you request it as well. So let's start by studying at the market, how I discovered it. I basically, when I first started in the real estate, I was in the landscape business, and I really wanted to be in real estate to cover my winters because you can't dig in the winter in Wisconsin where we're at here. And so I started to study different courses in real estate. And what I learned was that I didn't know enough about real estate to get started. I was very concerned about being successful in the first deal or two, because I had friends that had gotten in real estate in other parts of the country and had made mistakes and then got out. And I knew the value and always wanted to be in real estate as an investor. So when I was one of the common tools, and I actually was pre-approved with an investor and backing and bank backing, so I could close on any deal that I agreed on. But my formula that I was using was the Mayo formula, which we'll cover at a later time, but it was keeping me from actually being able to buy because the market was so hot when I was looking. I really wore out 3 different realtors, which means that they drove me around. They knew I was pre-approved. They just had to find me the deal, but my numbers would never work with their deals because I didn't know what I was doing. So I began to, on Friday nights when I came home from work, I began to spend about 2 hours when everybody went to bed looking at the entire county of which I was operating in. It doesn't have to be a county for you. It can actually be just a given area, a price point. But when I say studying, I, at the time, didn't have access to the MLS. So I would open about 3 different websites, usually my land records website, and then 2 or 3 different realtor websites at the time. We didn't have Zestimate at the time. This is back in 2004. And so what I began to do, though, is I looked at every single house that was on the market in my county from 0 to the top price. And I looked at those every single Friday night. And I would look at every single picture and look at the price points, and just really study the houses. And what began to happen was, after doing it for several weeks, you don't even have to look at every house, because you'll remember what that house looked like. But what happens is as they would disappear, because I wouldn't even get sold at the time, I would just notice that house was gone. So then I would go over to land records, and when it finally came to land records, you could see through land records what the price of the house sold for. So I could get a list price versus sold price comparison of what was actually happening in the marketplace. Now, when in my county, it's $3 per thousand. So if you go to land records to get a price, the way you figure it is you look at the transfer tax on the deed, and they charge $3 per thousand. So whatever the transfer tax is, you divide it by 3 and multiply it times 1,000. So if it was $100 in transfer tax, you divide it by 3, that would be $33 times 1,000. That house sold for $33,000. Your county may be different, or your area may be different what the transfer tax is, but that's how you figure it if you're going to land records. The other way to do it is just to look on Zestimate and Zillow and all these different national sites. The problem with Zestimate in general is they are not accurate, but there is an advantage and a disadvantage to that. They are not accurate, but they're still they're still looked at most frequently by all the buyers. So they are a measure of which you can start to look at and stare at your market with, because everybody in the marketplace is looking at them, even though everybody complains about their accuracy. I don't know really what the algorithm is behind it. I do know that if you pay attention to them, they do move quite a bit, and they generally move based on what stuff is listing on the same street. So paying attention and knowing where that value is matters. So I want to talk about what happens when you begin to stare at the market. You start to see where value is in deals, because really what you're looking for is you're looking for an equity position in a deal that you can buy, fix, and sell, or you can leverage a situation so that you actually can make a profit on a deal. As an investor, you cannot pay what a homeowner is going to pay that's going to live in it for 30 years. It's not possible. You have to have some way to make a profit in that deal. And there really is about 4 to 5 ways that properties have problems that you can help solve to create those equity positions. Number one, it just needs a rehab. So that's why I would drive neighborhoods, and I was looking online, I was really looking for a house that could be upgraded and have a value prop added to it by doing a rehab. So in my own market, what I began to see when I started staring at the market is, what is it that flags a house for a rehab situation? Now, number one, if the house has a roof where the shingles are curling and looks like it's about to leak, that house generally has a financial problem, a physical problem, or these are the problems that we're going to talk about, maybe tied to why it's in that shape. But if a house does not have a roof, it generally will not have a new kitchen. People fix roofs before they fix kitchens. So you can begin to look at property and see where those properties are in relation to having a hole in the marketplace, having a value prop that you can leverage off of to make some money. I began to get so good at this that now I can look at a house on Google Maps and tell you most of the things that are wrong with it just by the front street look. And this is why. If a house doesn't have a roof, or needs a roof, that's that bad, they didn't fix the kitchen. If they didn't fix the kitchen, they didn't fix the bathroom. Then you can look at the windows. If they've not been changed, that means that they generally need a window upgrade. The electrical upgrades are usually something that is required but doesn't get done if the main things are not, if the main things you're seeing on the outside are not fixed. They didn't fix the fancy stuff on the inside. Air conditioning units, how old are they? Because if it's got a brand new air conditioning unit, you can then assume that the furnace was upgraded too. So if it's got an old air conditioning unit, it needs a furnace. So you'll start to see these problems just from one screen. Even driving by the house, you'll see that as well. And you start to become attuned to, oh, this is a property that has an opportunity for you. In our own market, in the wintertime, because we have snow, if the snow is not shoveled, that's a problem. That means that property is not being paid attention to. If the grass is super long, that's another one that you'll see where there's a problem. Well, what are these different problems? One is it just needs rehab because people have not taken care of the property for years. One is a financial failure, meaning the people are about to be in foreclosure or short sale. One is a probate slash the heir-owned property where someone has died and they've left it to other people that are either out of the area or just don't care about the property and all they want is the cash out. Breakup slash divorce is another reason, and then worn out landlord is one of the last ones. As a matter of fact, a lot of times you'll see worn out landlords in leaving properties in the same condition, if not worse than other people. So what does this do for you to stare at the market? You'll start to see these values, and then when you start to study the market, you'll see where these values are, and then you'll be able to really appraise and have a good handle on what properties, as they come on the market, are worth because you'll know your market so well. What happens, and this happens all the time, is you'll have a house that's the same vintage, and let's just say like 1940 Cape. You'll have one that has everything done, but maybe the kitchen wasn't upgraded. And we'll just make some numbers up. So let's say that house without a kitchen sold for $180,000. Or let's say it sold for $200,000. And then let's say you saw another one that had a kitchen that was very similar in vintage and rehab, but it had a brand new kitchen, and that one sold for $180,000. So then you have another one come on the market, and it needs a little bit more updates in the kitchen, but it's only on the market at $160,000. If you know the one that sold without a kitchen fixed, without the new kitchen, sold at $200,000, that is a baseline of which the one that you're buying at $160,000 has about a $40,000 window to fix that kitchen and whatever little things and put it back on the market and sell. Most people don't understand this if they're not in the business for a long period of time, but that happens every single day in every market. There was a realtor in my market who is a seasoned, one of the top 5 volume sellers in the market, about 2 years ago, was selling multiple units of homes that were built in the 40s and 50s at $20,000 to $40,000 under value because he was selling them so quickly that he was making his sellers happy. But in reality, they had no idea they were losing $20,000 in equity because they had paid $45,000 for the house 30 years ago, and selling it at $160,000 to $180,000 was they were just excited to get all that equity. And in reality, their house was worth $200,000 to $250,000. So that's what we're talking about. And that being able to see that and buying those properties is how you create that equity position. And it's on the realtor for not listing properly to get all the equity out of those people. And even in the situation where there's a financial situation, a lot of people, because it's an illiquid asset, would rather just have their financial situation solved than have an actual top line price. And as an investor, what you're looking for is to find that equity to fix that problem and then get that top line price by making the property desirable for the marketplace. So understanding that price and value is what staring at the marketplace does for you. Another way to look at this, and I bring this up a lot, is when you want to go buy a new car, especially if it's a car you've never owned before, and you start to look at that car, all of a sudden you'll start to see all these other cars like that driving around because your brain starts to clue into, oh, this is something that once I start paying attention to it catches on in other ways. And the habits of like driving neighborhoods were so strong for me for a while that it would drive my family nuts because I would leave to go to the restaurant 20 minutes early and I'd be the last person at the restaurant because I would take a different road through town to be looking for those properties and discovering those properties. And then also by staring at the marketplace, you all of a sudden can even argue against and become better than the appraisers. So you'll develop ways of being able to see that value and prove out the value of your house when an appraiser actually has too low of a value and you can argue against it. Understanding price values, places to look. Like I said, you can look up on land records. You can use Zestimate. There's a couple of paid services. Property Stream and Property Shark are a couple of them. You don't really need those at the beginning. You really just need to get good at seeing the value in property. The other thing that I want to look at is like when you're talking about looking at across different markets. So school districts and amenities in a given area also will change value. You can literally have houses built on one side of a street and they're at one price point, and the other side of the street on another price point, because that street is a dividing line between a value prop difference. Most markets have what I call Snob Hill, which it doesn't matter where you're at. There is an area of the town that is highly desirable by the rich or the successful or the aspiring to be rich and successful. And then there's parts of town that are where lower rents would be, they get revitalized many times as well. But in general, that Snob Hill area is based on amenities, and some of those amenities are perceived amenities like, oh, other rich people live there. But it also can be school districts and or like closeness to shopping centers, malls, stuff like that. So those are things that you want to be able to determine. And by staring at the marketplace, you'll be able to see, oh, this house sold at this price point, and this house sold at this price point. This one was fixed up. They're both the same vintages, but this one was fixed up, but it was in the wrong part of town. The other one was not as fixed up, but is in the Snob Hill area or the nicer area. And that price point is stronger because of it. I learned this when I went to help my sister look at houses in Portland, Oregon. I was rehabbing a Cape / raised ranch variety. I looked at one for her that was almost exactly the same. I was paying $65,000 to $70,000 for my beat up units, and I was getting $140,000, $150,000, $160,000 in there for my finished product. And I was required to change all the windows because of the fact that we live in a very cold area. Where she lives in Portland, it's very, even though the day I was there was freezing, on average, they have a very warm and mild winter. So they were paying for what I was paying $65,000 for, they were paying $165,000 for, but they were getting close to $300,000 for the finished product. And they weren't having to change the windows, which I thought was terrible because I spent an extra $10,000 changing those windows. And they didn't have to change those windows, and they were still getting that higher price point. So the value prop, generally speaking, if you're in a higher price point area, there is more spread in each deal as well. Even though it was the same vintages, like when you walk through the houses in Portland, Oregon, they were the same, built the same years. These were like 1940s, 50s capes and ranches. They had the same trims, they had the same hardwood floors, they had the same style cabinets, two totally different parts of the world. Same window styles as we were, but there was $100,000 difference in what they were paying for the beat up property. And then there was about $150,000 difference in the top end. So there was more money to be made out there. That being able to see those different markets changes is why you want to have this skill of staring at the marketplace, or that staring at the marketplace gives you. I will also show you what we're going to cover on Thursday is actually where you can then equivocate, or you can look at different national markets and then tie them to where the marketplace is, and your local market is tied to where the market is in market life cycle, meaning the crash that everybody always claims is either coming or we're going into, or we just got out of. You'll be able to discern where your local market is in relation to anything negative that's going to happen in the whole marketplace. You will hear regularly, if you pay attention to the news, that the crash is right around the corner. I will give you my opinion on that on Thursday, and I'll go into great detail on why I have that opinion. But almost every day you'll read about how real estate is going to go to the floor tomorrow. Everybody's going to lose their equity. In reality, the 2008 crisis, 678 crisis, was a 100-year storm that will likely never happen again in our lifetime. It was caused by a whole bunch of things that started to happen in the 70s, and I'll give a list of what those things are so you can see that. That doesn't mean that we won't ever have a crash again. We will, but that volume that we hit was worldwide. It was caused by a whole bunch of things, and it's what everybody fears, but in reality, there's a lot of money to be made on both before that ever happens, or if it never happens again. There's still money to be made in the marketplace. That's what we'll cover on Thursday. As far as the other context of like how do you find these deals, or let's say you're not even looking to find the deals, you're looking to find guys that do the deals because you're looking to just put money into the market. Places to go find deals that you can just go to in your local market are RIA meetings. Those are generally meetings of investors that want to be investing. A lot of times you'll have amateurs in here, but you'll have seasoned professionals as well, because I occasionally go to these meetings as well. But all of them, if you're just looking to put capital in the market, in the real estate market, all of those people need capital. And so learning, you can go there to look for people. You can also contact brokers and agents. Like I said, even if you're looking at putting capital in, but don't necessarily want to be doing real estate deals yourself, you can take a drive looking for those rehab properties and talking to those guys doing the rehabs. And then you can also look for them on a national basis. We, as well as teach and talk about real estate in this meeting, we also will be offering deals that we have coming available. Today, the one we're going to talk about is a duplex, and we pay a pretty good rate of return based on the fact that we learned about the speed of money when we were doing quite a few rehabs. And the speed of money is tied to value creation, and it's tied to why we can pay a higher rate for money. On the package that we're going to look at today, it is a duplex that we're building. The finished value of the properties is $550,000 aside. So the building itself will be worth $1.1 million. We are offering 5 points and 7% on this one. It's a $690,000 investment. What that 5 points means is, and we'll send this out in a PDF as well after the call. But what that 5 points mean is when you send your $690,000 to the closing table, and all monies go to a closing table, they don't come to me. We have a note mortgage that is attached to a physical property for those monies. The 5 points get attached to the front of the mortgage. So the 690, 5 points would be $34,500. That gets added to the front, and then you earn 7% on that for the year as well. So the 360-day gain on this $690,000 is $85,215, which is about 12.35%. The reason we do that 5 points and 7% instead of paying a flat 12 is we can sometimes spend the money more than once a year. So if we spend your money twice a year, instead of it being 5 points plus 7% for the year, it ends up being 5 points. And then the second time you come in, you get another 5 points, and then the same 7%. So you end up going from 12% to 17% a year. And it offers our investors a higher rate of return for returning and doing more deals. Our desire is to get investors that want to keep coming back. And generally speaking, once we get them to come back several times, they come back over and over again, because they understand that we're trying to offer them a high rate of return for the speed of that money. We can send out, you'll get a PDF on this in an email shortly. So the entire deal is 360 days. The loan to value percentage, which is the thing that protects you as the investor the most. We do, like I said, all the money goes to the closing table. We have hazard insurance, title insurance for clear title, but the LTV percentage is what protects you, because our monies are above and beyond what we borrow, and that's how we pay. You get paid off before we get our money. And the loan to value percentage on this one is 62.73%. So there is about 40% equity in the deal above and beyond what the loan percentage is. We'll be presenting more deals like this in the future. Like I said, we do have time for some questions. Do you have any questions that have come up yet? None right now? Okay. like I said, go ahead and you'll get an email. Go ahead and fill out the or request the PDF. You'll get that, and you'll get more information about this investment opportunity. And then look forward to, we'll be covering on Thursday at 9 a.m. We'll be covering how you can look at the whole market by this staring at the market concept to protect yourself and knowing what's going on in your own marketplace. The nationally, internationally, real estate is commented on all the time, and that's where fear is driven, because in reality, even when a market is reported on nationally, it always behaves locally. And like we talked about earlier, even within a given market, there's different behaviors. So in those Nob Hill areas, they usually don't go down in value near as much as the areas that are beat up. So just because somebody is saying that something's happening in the marketplace doesn't make it so. And we will cover why real estate as an investment is such a powerful one, is why people like real estate, how it stacks up against the stock market, their advantages of the stock market, their advantages of real estate, and why you should be diversified in your portfolio of any type of investing, and why real estate actually adds a great piece to your portfolio. Thank you for watching today. Like I said, if we don't have any questions, we'll call it quits today, and we'll pick it up with you on Thursday at 9 a.m. Thanks, guys.